Hello and welcome to Tax Matters. My name is Olumuyiwa Matuluko. Welcome to the month of September 2014. Yes, the year 2014 is about to come to an end. Very soon you will begin to hear talks about the ember months being dangerous months. September, October, November, December. There's nothing like that. The simple truth is that a lot of traveling is carried out in those months of the year because it is end of the year. What is the panacea? Drive carefully. Don't drive when you drink. Don't drink when you drive. Avoid late night travels. Keep your vehicles in good conditions. Good braking system, good tires. New tires if possible. And all will be well with you. Last episode, we brought you the first installment of an expose on exchange of information and its implications for all of us. Mainly, that tax authorities now exchange information between tax authorities in a country like Nigeria, which runs a federal system, and between countries. And the overall implication is that it is no longer possible to avoid paying taxes. We rounded off the first installment with a little part of a story being told by Mr. Tablanche of the South African Revenue Authority about a foreign national doing business in South Africa who was living a life of luxury without paying due taxes. That is our takeoff point today. We begin this second installment with the full story as told by Mr. Tablanche. Sit down and enjoy it.
We've had a case where we've picked up a taxpayer who has been, according to us, under-declaring his income. And it was picked up based on the lifestyle that he pursued. And through the exchange of information process, we started to realize that the information that he provided to SARS was that his mother is very generous and she loves her son very much, and she was able then to provide him with sufficient funds in order to maintain his lavish lifestyle. But it was subsequently determined through the exchange of information process that his mother is a widower and she lived off a pension of her deceased husband, and she was never going to be able to maintain such a lavish lifestyle of the taxpayer. And although it was a prolonged process, we continued with the exchange of information process, and subsequently the taxpayer settled with the Revenue Service on the amount owed.
He settled? You didn't go to court? You didn't get jailed?
It was a prolonged battle, and what needs to be understood is the difference between a tax criminal offence and a civil tax liability.
Was that civil?
The taxpayer declared his income, under-declared his income.
Yeah.
The question around intent was a difficult question to answer. Also, a decision was probably made to continue with the civil process and extract the revenue from the taxpayer as opposed to continuing with a criminal litigation case.
This is a true story, isn't it?
It's a true story.
Are you saying that somebody who, if I heard you clearly on Monday, you were talking about the man having a Ferrari, a car, a Ferrari, having a yacht. Are you saying that that's not criminal? Or was the authority scared about spending too much money for lawyers? Too much money on litigation?
It is not, because the case went to court, but it went the civil process.
Yeah, I'm surprised.
It still cost a lot of money to fight the case in court. And it was up to the prosecutors to decide on whether they want to pursue a criminal activity or not. Because the taxpayer settled, we'll probably never know what the outcome of it would be. It would probably have been different if the taxpayer decided not to settle on his claim. But in any revenue authority, you will allow a taxpayer to come forward and to declare all his income and pay the taxes due, and hopefully through that process allow the taxpayer to change his non-compliant behavior to become a compliant taxpayer.
Go sin no more.
Absolutely.
You're okay with that, as long as you get your money?
Yes, and now he's becoming an advocate for tax compliance.
The tax dodger became an advocate for tax compliance. No problem. After all, the Holy Book tells us about Paul the persecutor turning later on to become an advocate for the Lord.
Every day, my people they for work. Some they do office work. Some get it them own business. So all of them want good road, constant power for better life. Oh, whether now office work, oh yeah, pay your tax. Whether now your own business, oh pay your tax. If you want a better life, oh pay your tax. Now your civic responsibility, pay your tax. Better soup, now money cook more. Oh yes. Nothing goes for nothing, my brother. If you want potable water, security and hospital for make life jolly.
That's right. Good roads, good hospitals, portable water, adequate security all come from taxpayers' money. Play your part in making Nigeria great. Everybody, small scale, big companies, entrepreneurs, do the right thing. Pay your tax. This message is from the Federal Inland Revenue Service, FIRS.
Welcome back. The program is still Tax Matters, and we're still looking at exchange of information between countries, especially those who have double tax agreements or double tax treaties, if you like, among themselves. And like we told you in the first installment, Nigeria is in the process of domesticating exchange of information because there are 37 tax authorities in Nigeria, the Federal Inland Revenue Service at the federal level and Boards of Internal Revenue in the 36 states. So the need for exchange of information within the country is very, very strong. And of course, going international, the FIRS is a competent authority under the Exchange of Information Framework. So when the need arises for Nigeria to provide information on any taxpayer doing business in Nigeria, it is the FIRS that has the authority to liaise with the State Board of Internal Revenue where that taxpayer does business. And then the FIRS will pass that information to the other country, Ghana, France, the United Kingdom. So for Nigeria, EOI is a countrywide affair. And our guest, who was one of the 5 guides that we had in the first installment, is still here with us. What are the essential ingredients of the EOI framework?
The United Nations model has been developed for developing countries, whereas the OECD model is mainly developed for the developed countries. But the essence of the exchange of information, Article 26, of both models are not significantly different. Both models achieve the same result, which is exchange of information on request, spontaneous exchange of information, and automatic exchange of information. The one thing that I do like about the United Nations model, though, is that it has an additional paragraph, paragraph 6, which really puts the obligation on both competent authorities to get together and, for all practical purposes, develop a memorandum of understanding of how the exchange of information shall take place. Because one of the more glaring aspects or shortcomings of the exchange of information process is that not all revenue authorities engage in exchange of information process. So if your model or if your double tax agreement puts an obligation on the competent authorities to develop a memorandum of understanding type of agreement, it then forces the 2 competent authorities to sit together and work out what the policies, the processes and the procedures should be to exchange information. And then it allows the revenue authorities or the competent authority to appoint a person, put a name to the face, and then allow the 2 countries to successfully exchange information.
Still talking about the general framework for EOI, we wonder if there's any link between the exchange of information framework and DTAs, double tax agreement, and transfer pricing.
The aspects around transfer pricing are increasingly important because a transfer pricing arrangement happens between two entities in different jurisdictions. So if the auditors of a revenue authority want to really establish what the connection is, they will have to have the ability to obtain information in a different jurisdiction. So it is increasingly important for revenue authorities to establish exchange of information teams that will allow the auditors to engage with the tax authorities of another jurisdiction in order to confirm whether prices are within the scope of the agreement and whether there were any transfer pricing arrangements that is untowards that was engaged in.
We do know that Nigeria, for example, has double taxation agreement with some countries.
Operationally in 10 countries. What part of the overarching rules now we have is that for what purpose are you signing, negotiating a tax treaty? Because tax treaty involves, ceding some taxing rights or subordinating your domestic law to the treaty. That if you have agreed to do, on so much within the treaty, you cannot now come and impose or enforce our domestic tax provisions on companies of the other country.
So if we don't want to go that whole hog, we can still have.
That's where the people now said you feel that you may not benefit because it shouldn't be a one-way traffic. A tax treaty shouldn't be a one-way traffic, whereby only one partner is having all the benefits of the treaty. The other one is not having. And I say, okay, after all, what do you need a treaty other than for me to have information about the activities of companies from the other country trading in my country, so that I can tax them appropriately. So once you enter into that TIA, Tax Information Exchange Agreement, which is not enforceable, it's a gentleman's agreement. Okay. At least you have information that you need. We're not talking about the issue about trading with and trading in Nigeria. The company may tell you that it trades with Nigeria, but not in Nigeria. But the other country can give you information that through and through, especially in this information superhighway age, that through and through is trading in Nigeria, not just with Nigeria. And if you have that information, you thank them, and then you can now go ahead and assess. So that's what that information in exchange, in agreement, can bring about without going through the whole hog of a full-blown tax treaty.
Is it compulsory for a country to subscribe to EOI?
The question can be answered in two parts. So you have your countries engaging into double tax agreements. And the moment that you engage in a DTA and there is an exchange of information arrangement or article in your agreement, then you're really obliged to exchange the information because the treaty says that you shall exchange information. When we look at an institution like the Global Forum, which allows countries to subscribe to the Mutual Administrative Assistance Agreement, the moment that a country becomes a member to the Global Forum, it is compulsory for them to exchange information, because you will not join the Global Forum if you don't have any intention to exchange information with any of the members of such a particular forum.
I almost stopped you. You said Global Forum. I thought that you made reference to Global Forum, using forum as a generic term. Are you saying there's an organization so-called?
There is an additional organization. The Global Forum was established approximately in 2008 by the OECD. And because it was really a member of the OECD, the indications were it was only for OECD member states. But countries have seen there was a need to exchange information with one another, and the double tax agreements were not really the best vehicle to exchange information with countries And obviously, where countries do not have a double tax agreement with one another, they cannot exchange such information. So the Global Forum became an autonomous organization in 2010. And the Global Forum became the custodian for the standards of exchange of information on request. And the ability for countries to join the Global Forum is presented to them so that they can actually start engaging in an increased network of exchange of information. And in order to become a member of the Global Forum, a country will go through what is called a peer review process. And the peer review process allows the Global Forum to understand if a country has the legal framework and the capacity available to exchange information. And once a country has passed the Global Forum's peer review, they will be granted membership to the Global Forum, and then a country has then the opportunity to ratify the Mutual Administrative Assistance Agreement. And it normally goes through your domestic process on how to enact such an international instrument. And once it is ratified and entered into force, then a country can start exchanging information under the Mutual Administrative Assistance Agreement with the countries that have also signed up to that MAA.
How do countries subscribe to the EOI? Is it once you belong to OECD or UN, you automatically subscribe to EOI?
It depends. Countries engage into double tax agreements. And as part of a double tax agreement, there is, when we refer to the model agreement, Article 26, which contains an exchange of information article. So when governments negotiate double tax agreements, they will also negotiate the exchange of information terms. So once an agreement is concluded and it contains the exchange of information clause in the double tax agreement, then a country is obliged to exchange information. But over time, exchange of information instruments have evolved, and we've seen in recent years the development of the Mutual Administrative Assistance Agreement. We've seen from the African Tax Administration Forum a similar type of Mutual Administrative Assistance Agreement. We've seen the development of a Tax Information Exchange Agreement, and more recently the development of an intergovernmental agreement. And those instruments focus primarily on exchange of information. It is not to do anything with double tax agreements. So the focus of those instruments are particularly on exchange of information. And countries have the option, when they join, for instance, the Global Forum, to sign up to the Mutual Administrative Assistance Agreement, and then they participate out of their own accord in the exchange of information process.
Under the Federal Inland Revenue Service Establishment Act of 2007, banks are now obliged to provide certain information to the FIRS. New account openings. In any case, you can't even open an account if you don't have a TIN, a taxpayer identification number. But the banks are to, on a quarterly basis, file returns as to new account owners. They are obliged to provide information on transactions above 5 million naira and to provide information on all the parties involved. So that law is there. But then I'm sure that some lawyers will still talk about secrecy. So when the UK gets information on me from the Nigerian tax authorities, or the Nigerian government gets information from the South African government on your tax affairs, how do you ensure that under the EOI framework you don't offend my sensibilities, you don't invade my privacy?
The exchange of information frameworks allows for countries to treat the information as secret in a similar vein as they would do under their own domestic law. So you'll find under any type of tax legislation that taxpayer information remains confidential information. and the exchange of information is between two revenue authorities. The issue around bank secrecy has been a contentious issue for quite some time.
Yes.
And the Article 26 of the double tax agreements is not incongruent to bank secrecy, because it gives the confirmation to taxpayers that their information will remain secret. But it doesn't allow a competent authority or a revenue authority to gain access to information that it would not in any case have been able to obtain under their own domestic law. And the bank secrecy provisions, I mean, every country has bank secrecy provisions, but it should not be to the extent where people are using bank secrecy as a way to evade tax, and even more so to finance terrorism activities and other illicit trades. So a competent authority in a revenue authority must ensure that the domestic legislation allows for them to gain access to such information without violating a person's privacy.
How does the FRS come into all of this?
Under subsisting Nigerian double taxation agreements, the competent authority is the Minister of Finance. And the Minister of Finance has delegated our powers as competent authority for tax treaties and exchange of information matters to the Federal Inland Revenue Service. Now, the DEX, or the organ of FRS that now handles exchange of information matters, is resident in the Tax Policy Department under the International Tax Division, and that unit charged with EOI is called the Competent Authority Liaison Unit. That unit is set up to help the competent authority, which is the Finance Minister, do the job of that office as regards to exchange information, mutual agreement procedures, and basically to build relationships with the tax treaty partners.
Okay.
That unit is charged with ensuring, one, that processes and policies and systems are developed to facilitate exchange of tax information between Nigeria and our treaty partners. What we call the process of outgoing tax information request or incoming request from treaty partners.
Okay.
Two, that unit is also set up to build relationships between the various organizations, external and internal, within FRS, that are important to the process of exchange information. By internal, I mean that if your treaty partner is asking for information and relates to a corporate entity in Nigeria, the information on corporates are resident with FRS. But the unit now goes to the department in FRS that will likely have that information. But if the information from the treaty partner requesting is on an individual, and the individual is not based in FCT where FRS has jurisdiction over personal income tax matters, it's based in Jigawa, for example, that unit will have to assist the competent authority go to Jigawa to get that information.
Okay, that's the linkage.
Yes. So the unit helps the competent authority do its job to get information, either to be the request of a treaty partner or to send a request outside to the treaty partner countries that Nigeria has DTAs with.
Finally, what do you need to do? What do I need to do?
If you're not tax compliant, then you should know that eventually the Revenue Authority will catch up with you. Because the increased exchange of information treaty network is ever expanding, it allows a Revenue Authority to continuously engage with the other revenue authorities, and the day will come where the non-compliance taxpayers will eventually be caught out. If you are a compliant taxpayer, there is nothing to fear.
It's like a big brother thing. I mean, there's no hiding place anymore for any taxpayer.
You can run, but you cannot hide.
There you are. A word they say is enough for the wise. Like we did in the first installment the summary bears repeating, and that is that, yes, globalization has made it easier for business transactions to be conducted seamlessly across borders. But the same globalization and the technological advancement that we are all enjoying have also made it impossible for those transactions to be hidden. And ultimately, that also means that taxes cannot be avoided. So what do? Pay your taxes as and when due, be transparent, and watch Tax Matters every week for tips on the workings of the Nigerian tax system. You have a blessed week ahead.